Hey there, January 30th, Scott Riley, the market update desk powered by Mortgage One. Closing out the end of the month here. Man, January has gone so fast. We are starting to get into some of the big data dumps for the week that we talked about. Starting today, we got consumer confidence, and this rose from an index level of 108 to 114.8 in January, which, by the way, is the best level we've seen in 2 years. Um, it was definitely unexpected and it was a big surprise in the market. The likely reason for the confidence has moved up the rate that has is because stocks, bonds have been doing so much better and inflation has deteriorated. So while this was a negative for the bond market, obviously for a lot of people's bank account, this was a positive. Um, the big one that we were waiting on today was the JOLTS report, the Job Opening and Labor Turnover Survey. This was also a little bit of a surprise today. So the JOLTS report showed job openings in December rose from 8.925 million to 9.026 million, which was stronger than expectations. It is interesting to see this rise when we are seeing a lot of high profile companies announcing layoffs, including today, UPS announced large layoffs, which was, on the heels of multiple other ones earlier in the week. Now, keep in mind, the JOLTS report does have some difficulty in counting things sometimes. It has a tendency to double count job openings because they're posted in multiple areas and multiple postings for the same job with different descriptions. So this is a bird's eye view, but not super correct when it comes to looking at these numbers in relationship to jobs creation and jobless numbers. So in December, the number of new hires rose with the hiring rate climbing from 3.5% to 3.6%. The number of quits was similar to November, with the quit rate remaining at 2.2%. Now, this signals that there are less hirings and less poaching of employees from competitors. So those are good things. Within the report, the biggest contributor to the openings was, again, a little bit of a surprise. Professional and business services added 239,000 job openings. Education, health services added 73,000. The big surprise, and been watching this one really closely, leisure and hospitality lost 131,000 job openings. Now remember, this has been the big one, the bull that's been pulling us forward with job openings and job creations. We're starting to see a retreat of that now. We talked about the Treasury refunding announcement. This is where the Treasury comes out for the quarter and says how much they're going to need to sell in bonds to adequately fund spending and costs. So the Treasury announced Q1 refunding needs of $760 billion. Now, that was in relationship to last quarter's announcement of $815 billion. So 5,500 less in bond sales, which obviously will help the bond market. Now, part of the reason for the lesser amount is that the Treasury goods account, think of it like that's the checking account for the Treasury general account, and it's near highs, so that Janet Yellen will probably tap the balance that's in there before borrowing more. So those are good signs. Case Shiller home price index, yep, higher appreciation, more values for existing homeowners. Now, an interesting thing in this report, for the second straight month, the city of Detroit here in Michigan had the highest month-over-month appreciation rate in the whole country. So we here in West Michigan are benefiting from that also. So great things for the state of Michigan. Case Shiller, which is defined as the gold standard of home appreciation analysis, showed that home prices rose 0.2% in November, and home prices have been on the rise since January and are now up 5.2% year over year. So Case Shiller is continuing to show that we're hitting all-time highs continually. And that the index now is on pace for a 6% appreciation for 2023, right in line of what we thought we would be between 6 and 7%. Definitely no retreat in the market. Those that followed a lot of the news, Diana Olick lost a lot of money listening to her, unfortunately. FHFA, the Federal Housing Finance Agency, showed what their appreciation was. Now, keep in mind, this does not count jumbo loans or cash offers, just conforming loan limits. And they reported a 0.3% increase in November and are up 6.6% for the year. Apartment Lists released their January rental report showing that new rents fell, not up, but down 0.3% during the month and are now down 1% year over year. It's the sixth straight month we've seen a drop. And now that's going to continually flow into the inflation reports, which are CPI and the PCE, which will bring our inflation lower and get us better mortgage rates. Internationally, the EuroZone showed that they are nearing a recession. Q4 GDP was flat, and that follows a slight decline in Q3 last year. So internationally, we talked about it yesterday, the EU may be hitting recession significantly, very soon, and could lay the path for where we hit recession, because that's usually a precursor to the rest of the country. Once one segment of the global economy starts a recession, it can flow over into the rest of the global economy. Well, that wraps up today. We hope that was informative. Wednesday, Thursday, Friday, we're going to have a lot of data to go over. Stay tuned. We'll get that to you. Give us a call, 616-293-2189 for all your mortgage needs.